The financial tsunami, why this could be the worst market crash in history. Picture this, you're standing on a beach, the sun is shining and everything seems peaceful. Then, without warning, the ocean starts pulling back. At first it looks calm, almost soothing, but you know better, you know that when the water recedes, a tsunami is coming. And here's the thing, there's nothing you can do to stop it. Right now, we're standing on the edge of a financial tsunami. It's not just a little wave. This is a full-scale disaster waiting to happen. And the warning sign? It's called the inverted yield curve. Now I get it. Inverted yield curve sounds like complicated financial jargon, but it's actually super simple. Normally, the longer you loan someone money, the more interest you expect. It's like getting paid more for mowing a lawn all day compared to just an hour. Makes sense, right? Well, right now that's flipped. Short-term loans, like 3 months or 2 years, are paying more than long-term ones. That's not normal. It's like getting paid more to babysit for an hour than for the whole weekend. It's upside down, and every time this happens, it's like the ocean pulling away from the shore. Something big and bad is coming. So, what's the Federal Reserve doing about it? Well, they're acting like everything is fine, cutting interest rates as if it's a good thing, a move that makes it seem like they're saving the economy. But here's the important part. When the Fed cuts rates, it mainly lowers short-term interest rates, like on 3-month or 2-year loans. This makes the yield curve go back to a normal shape, called uninverting. But if you know anything about rate cuts, here's the truth. They only cut rates when a problem is looming. They want you to think that lower rates are good for borrowing and growth, but in reality, they're trying to cover up an economy that's teetering on the edge. Let's be clear. The Fed doesn't cut rates when things are stable. It's a red flag that something is deeply wrong. Historically, rate cuts are the last-ditch effort to prevent a disaster. And if history has taught us anything, it's that the Federal Reserve has never gotten anything right, from missing the signs of the housing bubble in 2008 to countless other economic crises. Why would this time be any different? The truth is, massive unemployment, an impending banking crisis, and zombie corporations weighed down by unpayable debt are all creeping up. Don't forget the $1.5 trillion in commercial real estate debt that's about to explode, sending shockwaves through the banking system. Add to that over $500 billion in insolvent bonds, creating even more pressure on financial institutions. And all the while, the Fed keeps cutting rates, hoping it will hide the chaos, giving us a false sense of security. But it's time to wake up. The Fed only cuts rates when they know the storm is coming, but they're not telling you the full story. And this time, it's not just rate cuts. We're facing an impending banking crisis as massive commercial real estate loans come due, zombie corporations on the brink of collapse from unmanageable debt, global de-dollarization as countries move away from relying on the US dollar weakening its value, $35 trillion in national debt, growing at the staggering rate of $1 trillion every 100 days, over $500 billion in insolvent bonds that are putting financial institutions on the brink. This isn't just a typical economic downturn. It's a convergence of financial disasters, massive unemployment, global de-dollarization, and an overloaded system ready to crack under its own weight. The Federal Reserve can't fix these deep-rooted problems by cutting rates. Their track record shows they've never avoided a crisis with rate cuts. Why would this time be any different? But here's what your financial advisor or stockbroker isn't telling you, because if you knew the truth, you'd pull your money out of the market today. The inverted yield curve is a massive red flag, and yet they remain silent. Why? Because they profit when you stay invested. Their job is to keep you in the game, no matter the risks. But think about this. Warren Buffett is sitting on $280 billion in cash at Berkshire Hathaway. He's not gambling in the markets. He's preparing for the crash he knows is coming. Corporate insiders, the very people running the companies you're invested in, are dumping stocks at the fastest pace in a decade. They see the writing on the wall. And central banks? They're buying gold at levels we haven't seen in 55 years. That's no coincidence. They're securing their assets while they can. These insiders know the storm is coming. They know that when the yield curve inverts, recessions, and often massive market crashes follow. But they're not warning you because their interests lie in keeping your money in the market, even when the system is teetering on the edge. The question is, will you follow their lead or take control of your own financial future? And let's talk about just how bad those crashes were. In 1929, during the Great Depression, the market dropped by 90%. That's right, people lost almost everything. It took 25 years for the stock market to recover. Then, in 1974, during the stagflation crisis, the market fell by 45%. Unemployment soared, and inflation was out of control. It took years to recover. And in 2008, during the Great Recession, the market crashed by 50%, wiping out homes, businesses, and retirement savings. It took a decade for some people to even start recovering. And here's the kicker. The yield curve has been inverted longer than it was before any of those crashes. We're at 750 days and counting. The longer it stays inverted, the bigger the crash. This could be the worst market crash in history, the financial tsunami that will dwarf anything we've seen before. Right now, we're already seeing the first waves. Major companies are laying off workers across America. The water is pulling back. And the tsunami, it's going to wipe out jobs, savings, homes. During the Great Depression, unemployment hit 25%. Millions of people lost everything. And guess what? We're heading for something even worse. Here's the scary truth. There's nothing the Fed can do to stop this. Cutting rates doesn't fix the underlying problems. It's like sticking your finger in a leaking dam when the whole wall is about to collapse. The longer they wait, the bigger the wave that's going to crash. So, what's the high ground in this financial disaster? It's physical gold and silver. Why? Because when everything else is crumbling, stocks, bonds, even the cash in your bank, gold and silver don't collapse. They've held their value for thousands of years. There's no counterparty risk, no middleman. When you hold physical gold or silver, you're holding something real, something that can't just vanish. While everything else gets swept away, you'll be standing on high ground, safe with assets that won't disappear when the tsunami hits. So here's the bottom line. The inverted yield curve is flashing a bright red warning. The financial waters are pulling back. The tsunami is coming, and it's coming fast. The Fed's rate cuts won't save you. They're just the calm before the crash. The time to act is now. Protect your wealth. Get to high ground. Gold and silver are your defense. The financial tsunami is unstoppable, but you can survive it if you're prepared. Call Swiss America today at 1-800-289-2646 for a no-obligation free consultation to learn more about how to protect and preserve and privatize your wealth with precious metals. The wave is coming. Will you be ready? Call 1-800-289-2646. Don't wait till the wave hits. Take action now.